So good call last night, given that clearly we still closed down today despite a bit of a bounce this morning. Why were you thinking that last night?
Well, when you consider the scale of the epidemic at this point, it's hard to believe that we aren't going to start running into major supply chain interruptions and also, start seeing more pressure on earnings and free cash flow for corporations. The other thing is, I think we've reached a tipping point here, and that is if we can't get this thing contained soon, that is probably sometime this week, then, it's going to come to America. And once it comes to America, then we have an even more severe problem on our hands in terms of earnings and employment.
So you've been talking about, I think for the last month or so, that you think this market is looking like a bubble where central banks just come and liquidity rushes in and these assets get inflated. I wonder how you view that right now in light of the recent price action and whether you think it could just keep perpetuating itself if central banks from around the world keep coming in. Well,
it's interesting, Sarah. I think that if we can hold somewhere in this 3,000 to 3,100 range on the S&P, and we get some evidence that the coronavirus is being contained, then, I think that in all likelihood, central bank liquidity will just dominate and drive stocks even higher than we were. My call has been that we would be up 10 to 15% on the year, even though, that was pre-coronavirus. But, even though, these assets are massively overvalued. So, on the back of that, you also turn to the bond market, and, we have everything on the yield curve now comfortably below 2% yield, making historic new lows. In all likelihood, if central banks keep the printing presses running, that's just going to force bond yields down further, which will, help support speculative assets elsewhere, including junk bonds.
So what do you buy for protection? Do you buy bonds, even though they're already so low?
Well, that's a tough call, Will. When you look at where we are in the charts, where the 10-year note, if it has truly broken through the support that we've had in place for like the last 8 years, the target yield for it is 25 basis points on a technical count. Similarly, the target yield for the long bond is at 1%. So, in this environment, as a hedge, I think you need to have some exposure to bonds. And the other place where we've been putting money is into precious metals. Silver, in particular, we think is more attractive than gold.
So are you going to have to adjust that call that you made on the market to go up, 10% this year?
Well, I think it's premature because, as I said, I'm going to give the benefit of the doubt for the moment to the people that are advertising that this thing is well under control. But the real signal to me will be that the S&P breaks below 3,000, and then at that point, Sarah, I would probably start revising my outlook for the year.
Scott, thanks so much for joining us. We appreciate it.